Mortgage rate can feel pretty random. One week, rate improves. The next week, rate jump again. And if you're trying to buy a home, refinance, or invest in real estate, it can feel like nobody really knows what's going on. But mortgage rates are not completely random. There are a few numbers that explain a lot of the movements. Now, today, I want to make it very simple. You do not need to understand the entire economy. You do not need to watch every single Fed speech. You do not need to read a 50-page bond market report. You just need to understand three numbers. The first number is the 10-year Treasury yield. The second number is the inflation. And the third number is the mortgage spread. Freddie Mac's latest primary mortgage market survey shows that 30-year fixed mortgage rate averaged 6.53% as of May 28, 2026, up from 6.51% from previous week. That is the number most buyers care about. But that mortgage rate number is usually the final result. It is not the starting point. The starting point is what is happening underneath the rate. So in this video, we're going to break down three numbers that helps explain mortgage rate. First, we'll talk about the 10-year Treasury yield. Second, we'll talk about inflation. And third, we'll talk about the mortgage spread. And by the end of the video, mortgage rate should feel a lot less random. Let's start with the first number, the 10-year Treasury yield. This is one of the most important numbers to watch if you want to understand mortgage rate. Mortgage rate do not follow the 10-year Treasury yield perfectly. They're not the same thing, but they usually move in the same general direction. The 10-year Treasury yield is a benchmark for long-term interest rate. It tells us what investor demanding to lend money to the US government for 10 years. And because a 30 years mortgage is also a long-term loan, mortgage rates are heavily influenced by long-term bond yield. So when 10-year Treasury yield rise, mortgage rate usually feel upward pressure. When the 10-year Treasury yield fall, mortgage rates usually have more room to improve. This is why buyers should not only ask, what did the Fed do? They should also ask, what is the 10-year Treasury doing? Because the Fed controls short-term rates, but mortgage rates are long-term rates, and the long-term rates are more connected to the bond market. So if you see the 10-year Treasury yield jumped, do not be surprised if the mortgage rate jumped too. And if you see the 10-year Treasury fall, that is usually a better environment for mortgage rate to fall. Again, it is not perfect, but it is one of the best places to start. The second number is inflation. Inflation matters because mortgage rates are basically the cost of borrowing money over time. And when inflation is high, lender and investor want to be compensated for that risk. Think about it simply. If you lend money to someone today, but price keep rising in the future, the money you get back later may be worth less. So investors demand a higher return, and that higher return can push bond yield higher. And when bond yield rise, mortgage rate can rise too. This is why inflation report can move mortgage rate. If inflation comes in hotter than expected, the bond market may think rate may need to stay higher for longer, and that can push Treasury yields higher. Then mortgage rate can follow. But if inflation cool down, the market may think the Fed may eventually have room to cut, or long-term inflation risk is getting better. That can help Treasury yield move lower, and that can help mortgage rate improve. This is why one of the inflation report can change the entire mood of the mortgage market. It is not because grocery price directly set your mortgage rate. It is because inflation change what investors expect for the future, and mortgage rates are always looking forward. Now, let's talk about the third number. This is the one that most people never hear about, the mortgage spread. The mortgage spread is the difference between the average 30 years mortgage rate and the 10-year Treasury yield. For example, if the 10-year Treasury yield is around 4.5%, but the average 30 years mortgage rate is around 6.5, the difference is around 2% point. That difference is the spread. This spread exists because mortgage have extra risk. Homeowners can refinance. Homeowner can prepay. Mortgage-backed security can behave differently than regular Treasury bond. And investor needs to be compensated for those risks. So mortgage rates are not just the 10-year Treasury yield. They are the 10-year Treasury yield plus an extra spread. That is why mortgage rate can stay high even when the 10-year Treasury does not move that much. If the spread gets wider, mortgage rate can stay elevated. And if the spread gets narrower, mortgage rate can improve even if Treasury yields do not fall dramatically. So if you want to understand mortgage rate, do not only watch the Treasury yield, watch the gap between the yield and the mortgage rate. That gap tells you how nervous the mortgage market is. Now, let's bring all three numbers together. Mortgage rates are usually shaped by three forces. The 10-year Treasury yield tells us where long-term rates are moving. Inflation tells us whether investors are worried about the future purchasing power. And the mortgage spread tells us how much extra risk investors are demanding for mortgage-backed securities. So when someone asks, why did mortgage rate rise? You can ask three simple questions. Did the 10-year Treasury yield rise? Did inflation fear increase? Did the mortgage spread widen? If the answer is yes to one or more of those questions, that probably explains a lot of the move. And when someone asks, when will mortgage rate fall? You can ask the opposite. Are Treasury yield falling? Is inflation cooling? A mortgage spread tightening? If those happening together, that is usually a better environment for mortgage rate. But if inflation is sticky, treasuries are high, and spread are wide, mortgage rate may stay elevated. This does not give you a perfect prediction. Nobody can predict the mortgage rate perfectly, but it gives you a much better way to understand what is going on. So what does this mean for buyer? It means that you should not only watch the Fed. The Fed matters, but the Fed is not the only thing that moves mortgage rate. Mortgage rate can move before the Fed speaks. Mortgage rate can move after inflation report. Mortgage rate can move because the Treasury yield change. Mortgage rate can move because the mortgage spread changes. So if you are planning to buy a home, refinance, or invest in real estate, understand the bigger picture. Do not panic over every daily movement, but also do not assume rate only change because the Fed has a meeting. The bond market is moving every day. Mortgage rates are connected to that market. So here's a simple takeaway. Mortgage rates are not random, and they are not only controlled by the Fed. If you want to understand where mortgage rates are going, start with three numbers: the 10-year Treasury yield, inflation, and the mortgage spread. The 10-year Treasury tells you what is happening with long-term interest rate. Inflation tells you how worried investors are about future prices. And the mortgage spread tells you how much extra risk the mortgage market is pricing in. If all three are moving in the wrong direction, mortgage rate can stay high. If all three start improving, mortgage rate may have room to fall. So next time you see mortgage rate move, do not just ask, what did the Fed do? Ask, what happened to the 10-year Treasury? Ask, what happened to inflation? Ask, and what happened to the mortgage spread? Because those three numbers explain a lot more than most people realize. That's all for today. That's my simple framework for understanding mortgage rate. Thank you for watching.